Right now, we all know it's a seller's market, and we're here to give you some tips on some mortgage pitfalls that might cause a closing delay. Hello, everybody. My name is Barry Horvath, and this is Moving Forward TV with your local market update.
And I am DeLynn Gaston. Thank you so much for joining us today. So it's very exciting. I know it looks kind of similar to you guys, but we're in a new location.
Yeah,
we're in a new
the
set.
brand new
This is like huge. I know.
Yeah.
This is, and it's very exciting. It's very large. And if anybody is in the area, by all means, reach out to us. We'd love to have you come and see it.
Yeah, it's an amazing new facility, and we're grateful to be a part of it here.
Yeah.
So I like the new location. You know what I like about it?
Because it's a little closer to your house.
Closer to my house. But it did take me longer to get here.
Not a morning person over
Not
there.
at all. I know. Although I was here on time today, so.
I know.
But I didn't know where to go. So
I know you were just at the other end. And
but it's all good.
I, of course, was a little bit late.
So we got a lot of new things happening out there.
We do. What a crazy time, right?
Yes.
You know, just when you think COVID's over, and then it rears its ugly head again, and it kind of starts to come in again,
the new strand.
and the market has not slowed down.
Not one tiny bit.
Not one bit. But all of you buyers out there already know that. All of you realtors out there already know that. Things are getting a little crazy.
So
the prices are still going a little nuts.
There's just new things happening every day, and our industry is changing every single day. So we want to keep you up to date on all the changes that may impact if you're buying or selling a house, or if you're in real estate, how this ever-changing market can affect you, basically. So.
And it is affecting things. So, from appraisals and inspections and the mortgage processing and everything else. So there's definitely some changes. Fannie Mae and Freddie Mac had put some overlays on underwriting guidelines a year and a half ago due to COVID. And actually, the strange thing is... What's COVID? They just removed those guidelines. It was like, oh, hey, look, Fannie Mae just removed the guidelines, the additional COVID guidelines, things that we had to get prior to closing. They just removed them. I'm like half waiting now, anticipating for those new Fannie Mae emails that say, oh, guess what? We're putting those guidelines back on. I don't know. We'll see.
Well, if you don't like what's happening, just wait a minute.
Just wait a minute.
So let me share something else new with you.
Okay.
These are my new glasses.
That's right. So, I know. This is the first time you're filming with glasses.
Yeah, so this is the first time in my entire life I've had real glasses. So try to get used to them.
I know. Remember mine?
And I don't really need them.
I think mine was like 3 years ago, wasn't it? Yeah. Or something, and it's doing the same thing. Look, I have glasses now.
Yeah, and I don't really need them to see everybody, but when things are up close, I need, if I just had longer arms, I would be fine.
Perfect.
So, yeah, but the eye doctor tells me, well, things will be, you're seeing right now in high def, but, there's ultra high def now. So you can see in ultra high def from the distance.
Look at you.
So give it a shot.
So when I got my glasses, I can remember driving, because I used to say to my kids as I'm driving down the road, read that sign for me. What's that one say? Which was pretty scary to them. So then when I got my glasses, I'm like driving down the road and I'm like reading every sign. Are you like reading all the signs now? Oh, look, I could read that. Oh, I could read that.
And I did get a new razor this morning, so I have a new nick to share. So.
Good to know.
Do I share too much? All right. TMI, sorry.
All right.
But it's all good.
But anyway, so should we talk about mortgage pitfalls?
Listen,
instead of facial pitfalls?
I'm only sharing it because I can actually see it right now.
I know.
So if I can see it, that means our viewers can.
The funny thing is I honestly didn't even realize that.
Yeah.
I didn't notice
so,
it.
yeah, you can zoom in on it. Anyway, let's talk about, we like to have fun, so that's important. Let's talk about what can cause closing delays, the pitfalls of the mortgage industry, our side of it, And, we want to make sure that you have a smooth closing. So we're not here to ever sell you anything. We just want to educate you.
Educate.
And we want to educate buyers and sellers because sometimes, we're in the trenches every day. And DeLynn's like, oh, we don't need to tell them that. I'm like, DeLynn, we do. Sometimes we have to, for some of you, we may dumb it down. But I want you to think about the first-time home buyer as a real estate professional that you're dealing with that may not completely understand what's actually happening. So
Exactly. So a lot of these questions, we know a lot of our audience is realtors, and you guys already know this stuff, but we're just kind of sharing it to remind your buyers, because believe it or not, they don't know a lot of things that you and we take for granted because we're in the business and we're in the industry every single day, and these are the things we talk about. For example, we talk about a mortgage application as a 1003 sometimes. That's the Fannie Mae form number. Nobody knows what that means, but we have to remember that nobody else knows what that means. You guys might talk about things like, an EMD. That's a biggie. People have no idea what an EMD is. We have to explain it to them. That's that deposit money you put down.
What's an EMD?
Let's start right there.
Is that when you have chest pains?
So
call the EMD?
I know. Call the EMD. So EMD, earnest money deposit. So to you buyers, when you do first buy a house, be prepared. You're going to have to write a check. It's kind of like a good faith money. It's like $1,000, $2,000, $5,000, depending upon the price of the house. Depending upon the price of the house, they're going to want your seller. Now, that doesn't go right to the seller. You don't write it out to Joe Smith, Mr. Seller. You write it out to the title company who is going to be doing the closing transactions should everything go through just fine. And they will hold it and they don't release it to the seller until closing. So that money does go towards your down payment. That's the other thing. A lot of times people think it's just a fee. It's not a fee. It goes towards your down payment.
And it's so funny that you said, make sure you write a check.
I did say, make sure you write a check.
Because if you bring in money order or cash, although the title company will gladly accept that as an EMD, if you are getting a loan, remember that money cannot be proven. So it may be disallowed as part of your down payment or towards closing costs. In other words, remember when you're borrowing money, the lender has to prove every asset that you have. And if you walk in with cash or money order, you're not going to be able to source it. So that might be your first pitfall of the day.
Exactly. Right there up front in the beginning. And realtors, please tell people, don't pay cash. Don't go do it with a money order. Don't do it with a cashier's check. Do it with a regular personal check. We have more than enough time for that check to clear. So they give it to the title company up front.
And a wire is also unacceptable because we can source it.
Right, that's fine as well.
In fact, with COVID, most title companies love that you send wires because it's instant, it comes right through, and poof, you're done. So.
And what are they? Touchless, right?
Yes.
Touchless.
Yes, everything's touchless.
Nobody has to touch a check.
All right, so let's talk about a lot of lenders out there right now are issuing these pre-approval letters. So we want to talk a little bit about the difference. And I know sometimes pre-approvals or pre-quals are not worth the paper they're printed on. I hate to say that, but that's
truth.
That's just the reality of it. Certain lenders, I won't mention their name, but they will literally pull your credit. You have a qualifying score, which is part of the pre-qualification process, but maybe they didn't verify everything. So a pre-qual versus a pre-approval, there's a big significant difference. And a lot of sellers in this seller's market really don't even want a pre-qual anymore. They want a true pre-approval or a pre-approval within a certain number of days or a mortgage approval. So DeLynn, what's the difference between a pre-qual and a pre-approval?
And I was just going to say, and sellers don't really know that. That's a smart agent. That's a good agent, a listing agent who knows to educate her seller. There's a difference between a pre-qualification and a pre-approval. And your biggest difference on a pre-qualification, for the most part, it's just verbal. Somebody calls up one of those online lenders or goes online or whatever. Like Barry said, the most important word in what you said is when they run your credit, that is only part of the pre-approval process. So, and that's the first thing, unfortunately, a lot of these companies do before they even talk to the person or find out some information on the person. The first thing they do is run a credit report. And if they've got a qualifying score, boom, they give them a pre-qualification. Yeah, you're good. You're pre-qualified. They kind of hide behind that. I hate to say that, but that's, I think, what they do is they hide behind that. That is merely just maybe some verbal information, maybe just a credit pull, maybe just, nothing has been verified. On a pre-approval, it actually has been verified. A licensed loan originator has looked at the paperwork provided by the buyer, viewed all of the tax returns, the W-2s, the pay stubs, the bank accounts, viewed all of that documentation and run it through an AUS, an automated underwriting system. That is your pre-approval.
And remember, just because you have a pre-approval doesn't mean there won't be a pitfall that can surface its ugly head later. There are a lot of things that come up, and we're going to talk about what can go wrong during the process. We don't want to be, Debbie Downers per se, but This is reality. These are things
we see happen all the time.
And if you're in real estate, you can help educate people of avoiding these pitfalls so that we don't have a closing delay.
Right.
So it's important you know the difference between that pre-qual and the pre-approval. So the borrower does need to provide documents. I know in our office, we tell them, hey, we've got your pre-qualified, and we issue you a pre-qual in our quick qual system, which is amazing, and we'll talk about that in just a minute. But in quick qual, we actually have the option to mark it as a pre-approval or a pre-qualification. We tell borrowers, here, you're now, you're pre-qualified. Get us your documents within the next 24 hours, all supporting documents, like DeLynn said, those pay stubs, the W-2s, tax returns, any required documents that have surfaced during the initial process. Then if you provide those documents, we can move it over to a pre-approval, which means we can run the AUS findings, which is basically an electronic approval from Fannie Mae, Freddie Mac, et cetera. So important that you know the difference of that. And then let me tell you a little bit about Quick Qual. Once we get them pre-approved, Quick Qual is amazing. I know you love it. At first we were like, oh, this is hard, right? Now it's like, how did we ever live without it?
I know. And our realtors love it, and our buyers love it.
Especially in this market.
It's a nice thing. So any of you realtors who would like to know more about it, please reach out to us. It makes it nice that you have at your fingertips the ability to change someone's pre-qualification, pre-approval, whatever we're working with. You have the ability to change it based upon a certain purchase price, or maybe the seller counteroffered with higher. You have the ability to change it at your fingertips and print a new letter anytime you'd like.
And you know what? The buyers love it because they can see, okay, I'm pre-approved for this amount. Here's my approximate monthly payment. If I put in the taxes, here's the amount. Insurance, here's the amount. Here's my total payment. Oh, and I know I have this much available for closing. Here's how much I'm going to need approximately to come to closing. Buyers love it. And in the seller's market, we have people putting in multiple offers. We have 20, 30 offers, right? Do you really want to be able to try to get a hold of your lender at Friday night at 10:30 when you just saw the house that multiple offers are coming in, and you want that pre-approval on the spot? They can be in the house on their phone and generate that pre-approval or pre-qualification.
Instantly.
Boom, right on the spot. For those of you who are afraid of technology, don't be afraid of this. It's really simple, and it will help your business.
Even we can do it.
Yeah. I mean, I don't know how to use a razor, but I can use Quick Qual, okay? Don't give me a new razor blade.
But he's got Quick Qual down. All right, let's go on to
Look,
other.
They're zooming in on my spot.
Did he zoom in on it? That's funny. All right, so let's go on to the other thing that a lot of times home buyers get confused with: inspections. Home inspections, because again, it's one of the first things right up front. And this obviously, and you realtors are very good at explaining to them the pitfalls that happen with a home inspection, the importance of getting one, and what could happen during that. You guys are really good at doing that up front. home buyers, what they don't understand is that in addition to that, there's also an appraisal, and they think it's kind of the same thing. So the difference between an appraisal and a home inspection is very important to tell people. An appraisal is not something that the buyer can choose and not something that the lender can choose anymore. Actually, it has to go through what's called an AMC, an appraisal management company, who is in charge of arbitrarily, with no ties to anyone, choosing an appraiser because of all of the fraud that happened in the mid 2000s. They're very strict on this now. So an appraiser, his job is to make sure from a value standpoint that the property is not being sold for over. Kind of funny in this day and
Yes,
age.
it is.
Home inspection obviously is when your home inspection is going to tear your house apart. He's going to like turn on every light switch. He's going to, turn up the air conditioning, turn up the heat, turn it down again, time it for how long it takes to do those things, climb up onto the roof, climb into the attic, up north, go down into the basements and things. We don't have that down here. But that's what your home inspector, he's going to give you a report of every single thing that's wrong with that house. And you have to look at that report and say, okay, I can live with this. I can live with this. I can fix that. I can fix that. And then and go over it with your real estate agent, because they're going to tell you the things that you really need the seller to fix ahead of time.
And remember, your lender does not require a home inspection. Your realtor will absolutely recommend one, but we don't require one. We don't need to see it. We don't need to be a part of that. Your lender only requires the appraisal. And you know what? I think where people get confused is now when we order an appraisal, we say, okay, they're scheduling the inspection. What they mean is the appraisal's done a lot of due diligence, doing comparable sales to give you the valuation, or the lender the valuation, but they also need to go in and inspect it. Now, that doesn't protect you as a home buyer. They're just looking to make sure that the walls are where they're supposed to be, that, the pool is not, the pool is functioning, it's not murky green, that the roof is on there, there's not a gaping hole in the ceiling. That's a different type of inspection. They're looking for valuation and safety issues. So please don't confuse. And I know some realtors are like, well, I know what the difference is between an inspection and an appraisal. Well, a lot of buyers do not know that. And if you're new to real estate, you may not know that the lender doesn't even require an inspection, because I still have agents that want to send it to us.
I know.
We don't want it. We don't need to see it. I don't want to know about the problems with the house, really, like
No.
la, 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 but
Plausible deniability.
yeah, we don't want to get into that side. We want to make sure that there is good collateral. That is our role. That's why the appraisal does.
As long as you're happy with the home inspection, that's all we need to know.
And the inspection assesses, what's the risk for the borrower? What could potentially be going wrong in the future? Is the water heater going to need to be replaced in the next year? Is the roof going to be a problem? I mean, and you should do a home inspection, because now, especially with insurance, with those 4-point inspections, you can save the money right there up front just from that 4-point inspection, because you will get a discount on your insurance if it meets the qualifications. So keep that in mind. And that keeps your payment low. Isn't that what people are all about, that low payment?
All right, so let's move on to the reasons for deniability, moving from appraisal. So don't you think it's the time to move on to the deniability?
What happens?
I don't want
what
to
can
lose
go,
time.
we're talking about what's going wrong, what can go wrong during the process.
So we've moved up, a couple of weeks here. Now the loan is in process and everything is going. And this is where the underwriter's job and the processor's job is to see how these things worked out. Now, one of the things, to make sure in your initial approval up front, we said we ran it through the AUS, which is the Fannie Mae or Freddie Mac system, and it comes out with an approval. And it comes out with like a 7 to 15 page approval saying we need all of these things. Basically, we have to tell Fannie Mae, we have to prove everything we put into the system. So that's what this process is about, is verifying the employment, verifying the overtime, verifying the, if they're paying alimony or child support or receiving alimony and child support. We have to verify all of these things. And it's a lot of stuff and it's a lot of paperwork, and we try and get as much as possible in ahead of time, but sometimes you can't because they're still getting pay stubs. They're still getting, paying their bills and things like that. So this is where sometimes some of the stuff starts to fall apart a little bit. But we definitely wanted to talk about what is allowed to deny a file and what is not allowed. And believe it or not, a low appraisal, and I want to get this is very important. If the appraisal comes in low, because it's been happening lately, that is not a reason to deny a file.
As a lender, we cannot help you get your escrow back and give you a denial letter because the appraisal didn't come in. Now, there is contingencies in the contract.
I was just going to say, please, please, please always do an appraisal contingency. That is the only thing that is going to protect you in there.
If you waive your right to that, then you do not have the option to get out of the contract if the appraisal comes in short. You could lose your EMD, and you can fight it. You can go to court. And by the way, the title company cannot help you make that decision and back you because the title agent's your friend. Both parties have to agree to release an escrow. I wanted to throw that in there.
Yeah.
And people fight about that often.
I know.
So
let's put the chart up if we could. These are the reasons. This is right off of a Fannie Mae approved lender denial letter. So this is, and we all use the same form. So this is pretty much what the denial letter looks like. This is like the guts of it, right smack dab in the middle. So you can see on here, these are the only reasons, the only legal reasons that a lender is allowed to deny a file. And we would check off which one of these things happen. Now, a lot of them right up front, we know if the person doesn't have a credit score at all, those things are easy. And that's the stuff
those
that we find out
probably in the front
beginning.
end you would find out.
A lot of the
not
stuff
while
is in
it's
the front
under
end.
process.
Although further down where it talks about bankruptcies and foreclosures and things like that, I will tell you people try to hide that stuff.
Yeah.
Because maybe we had somebody who had a foreclosure, 7 actually foreclosures. And when I asked them the question, have you had a foreclosure? They answered me no. But then when the fraud report runs, we find out that they had 6 or 7 foreclosures in another state. And they thought because it was in another state, it was up north, that it didn't count. So, these things come up later on sometimes, and that's one of the things. Employment status. If somebody does lose their job and we can't verify that they are still employed or whatever, that, of course, is a reason to deny a file. Temporary or irregular. Sometimes people, if it's seasonal, mandatory layoffs, that happens. This used to happen up north with lawn companies. In the wintertime, they are laid off. And as long as it's every year, that's fine.
Right.
But if it's not.
And when people have less than 2 years of a job history and they don't tell you about it, and then when we go in, even though we have a recent pay stub, it shows they're on that job, and a W-2 showing the prior year on that job, maybe they weren't there and they had a huge gap in employment.
Right.
When we order the verification of employment from the previous employer, that's when that can come up and be an issue. So don't lie on your application about your dates, and time at employment. We're going to find out about it because we do verify.
Don't change jobs. Yeah. That's why it says length of time on employment. Don't change jobs in the middle of the whole process. And I know people say, well, it's in the same line of work. Yes, that's right. But we cannot close on your file until you have a pay stub from the new job. So that could delay your closing, especially if you get paid every 2 weeks. What they're going to do is most companies hold back a week, or whatever. So it might be 3 weeks before you get a pay stub and you're supposed to close in 2 weeks. That's going to be a problem. And that's going to cause a delay in your closing.
I just want to back up too, because on the credit side, people go in and they do. If you apply for credit during the mortgage process, even if you don't get the credit card, it's going to come up. Because remember, lenders must verify. They do what they call a credit refresh on your credit report. Even though we got a credit report and you have a qualifying score, we do a credit refresh. What does that mean to you? That means if anybody inquires on your credit, we're going to know about it. And so don't do it. And don't go to Rooms to Go. Sorry to pick on Rooms to Go. Just because there's no payments for 25 years on the furniture you bought. Okay?
25 years.
I'm not exaggerating. It doesn't matter. It still counts into your debt ratio and it can mess up your deal. even if you don't take a credit card, when they offer you 10% at Kohl's for checking out today, even if you don't take the card, it's a credit inquiry. You're going to have to explain it. Don't do it during the mortgage process.
And one of the hardest things with explaining in the mortgage world is explaining something didn't happen. So let's just, in your example, Kohl's pulls your credit and you say, no, I decided I'm not going to take the card. Now we have to prove you didn't take the card. How do we prove you didn't take the card?
Yeah. Isn't that funny how that...
That's very hard. So better off don't do it. Just don't. If you're in the process or thinking about going to buy a home in the next few months or whatever, just don't. Don't let anybody run your credit. Don't
it will mess with
fall into those
it's
things.
all about debt to income ratio from a lender's perspective.
And then the last thing on our chart, just real quick, I wanted to touch on was, and I don't know if you guys caught it or not when the chart was up a little while ago, is the other category. No, we cannot type in that box low appraisal.
Yes.
We can't type in that box low appraisal. That is not a reason. Unacceptable property is, for example, if it was a manufactured home and it doesn't have the right tie downs or something, that are stuff that comes out later on in inspections or, something like that. It hasn't had the title retired or something. That would be unacceptable property. If the other thing is, I just talked to our appraisal people about this the other day. If somebody, the seller refuses to make improvements that the appraisal is requiring,
right,
that is a reason it's an unacceptable property.
There you go.
So
that falls into that category.
That falls
into that category. And the other big thing that comes up, and then we're going to cover all this in our upcoming Lunch and Learn. We're going to announce that in detail so you can interact with us, is the verification of income. We do order transcripts from the IRS. If you had a side business with Mary Kay, that's why we ask you for tax returns, because we're going to verify what you filed with the IRS matches exactly what is on your paperwork and your 1003, your application.
So many things can fall apart. I actually had somebody new say that to me one time. He said, it's like worse than the game of telephone. So there's so many things that have to happen in perfect order that could go sideways. So many things that could happen. But
all right, here's our Lunch and Learn coming up. It's on September 14th. Don't forget, join us. We can interact with you. It'll be live via Zoom. We want to keep everybody safe, so we are back to Zoom on that. But we'll interact. We'll answer your questions. We'll have open discussion about all of these pitfalls. I think it's going to be a great topic.
Right, I do too. And this is for you guys to ask us questions as well, because we get a lot of, onesie questions that other people can certainly benefit from as well.
Hey, great information. Don't forget to share us, like us.
Thanks everyone for watching. We are Today and Every Day.
Moving forward.
See you next week.
Have a great week.